Hello and welcome to ValueNivesh. In this video, we will be discussing the debt-to-equity ratio. In this video we will be talking about some important parameters such as: what is debt-to-equity ratio? How to calculate debt-to-equity ratio, and we will see simple example. How to interpret debt-to-equity ratio? How is debt-to-equity ratio used to value a stock? How is debt-to-equity ratio manipulated by companies? And lastly, the summary. But before we dive into the details, I would like to request you to subscribe to our channel and hit the bell icon to stay updated with our latest videos. Also, if you like the content of our video, don't forget to like this video and also share it with your friends and family to support our channel. What is debt-to-equity ratio? Debt-to-equity ratio is a financial ratio that indicates the proportion of debt and equity used to finance a company's assets. It is a measure of a company's financial leverage, which helps investors evaluate the risk associated with the company's debt levels. In simple terms, the debt-to-equity ratio compares a company's total debt to its total equity. The ratio is calculated by dividing the company's total liabilities, including both short-term and long-term debt, by its total shareholder equity. The formula to calculate the debt-to-equity ratio is: debt-to-equity ratio equals total liabilities divided by total shareholder equity. For example, if a company has total liabilities of 1 crore and total shareholder equity of 2 crore, its debt-to-equity ratio would be 1 crore total liabilities divided by 2 crore total shareholder equity, which is equal to 0.5. How to interpret debt-to-equity ratio? Interpreting the debt-to-equity ratio depends on the industry in which the company operates. Generally, a lower debt-to-equity ratio is considered better because it indicates that the company is relying less on debt financing and has a stronger equity position. However, in some industries such as utilities and telecommunications, higher debt-to-equity ratios are common due to the nature of their business and regulatory requirements. In these cases, it is important to compare the company's ratio to other companies in the same industry to determine whether the ratio is appropriate. How is debt-to-equity ratio used to value a stock? The debt-to-equity ratio is a financial metric that measures the proportion of a company's debt to its equity. This ratio is used by investors and analysts to evaluate a company's financial leverage, which can have implications for its risk profile and potential for growth. When it comes to valuing a stock, the debt-to-equity ratio is one of the many metrics that investors may use to determine the underlying value of a company. We will see few ways in which the debt-to-equity ratio can be used in stock valuation. Number 1 is comparing companies within the same industry. Investors can compare the debt-to-equity ratios of different companies within the same industry to determine which companies are more financially leveraged. A higher debt-to-equity ratio may indicate that a company is taking on more debt relative to its equity, which could lead to higher interest payments and potentially greater financial risk. By comparing the debt-to-equity ratios of different companies within the same industry, investors can gain a better understanding of which companies are better positioned to weather financial headwinds and which companies may be more vulnerable. Second way is by analyzing changes in the debt-to-equity ratio over time. Investors can also analyze changes in a company's debt-to-equity ratio over time to gain insights into its financial management practices. For example, if a company's debt-to-equity ratio is increasing over time, it may indicate that the company is taking on more debt to finance its operations. This could be a sign of aggressive financial management or an indication that the company is having difficulty generating profits. On the other hand, if a company's debt-to-equity ratio is decreasing over time, it may indicate that the company is paying off debt and becoming less financially leveraged, which could be a positive sign for investors. Third is by comparing debt-to-equity ratio to industry averages. Investors may also compare a company's debt-to-equity ratio to industry averages to determine whether it is more or less financially leveraged than its peers. A company with a higher debt-to-equity ratio than the industry average may be taking on more risk, while a company with a lower debt-to-equity ratio may be seen as more financially stable. Fourth is by using debt-to-equity ratio in conjunction with other metrics. The debt-to-equity ratio is just one of many financial metrics that investors use to value a stock. To gain a more complete picture of a company's financial health, investors may also consider other metrics such as the price-to-earnings ratio, price-to-book ratio, and return on equity. By looking at multiple metrics in combination, investors can make more informed decisions about whether a stock is a good investment opportunity and whether it is undervalued or overvalued. How is debt-to-equity ratio manipulated by companies? Debt-to-equity ratio can be manipulated by companies in several ways. Some of the common ways are: 1 is creative accounting. Companies can use creative accounting techniques to manipulate their financial statements in order to show a lower debt-to-equity ratio. For example, they can defer expenses or overstate revenue to make their debt appear lower than it actually is. 2nd is leasing assets. Companies can use leasing to manipulate their debt-to-equity ratio. By leasing assets instead of buying them, they can keep the liabilities off their balance sheet, which makes their debt-to-equity ratio appear lower. 3rd is share buybacks. Companies can use share buybacks to manipulate their debt-to-equity ratio. By buying back shares, they reduce the amount of equity on their balance sheet, which makes their debt-to-equity ratio appear higher. 4th is off-balance sheet financing. Companies can use off-balance sheet financing to manipulate their debt-to-equity ratio. By using special-purpose entities or other structures to finance their operations, they can keep their debt off their balance sheet, which makes their debt-to-equity ratio appear lower. It's important to note that while companies can manipulate their debt-to-equity ratio, it is illegal to do so through fraudulent practices. Investors should be aware of the potential for manipulation and use multiple financial ratios to evaluate a company's financial health. In conclusion, the debt-to-equity ratio is an important financial ratio that investors and analysts use to evaluate a company's financial leverage and risk. A low ratio is generally considered better, but it is important to consider the industry and compare the ratio to other companies in the same industry to determine whether the ratio is appropriate. So that's it for today's video. I hope you found this information useful. If you did, please give this video a like and share it with your friends. And once again, please subscribe to our channel to get more videos like this. Thank you for watching, and we will see you in the next video.